All right, so welcome to another video. Today we're going to be talking about the easiest option strategy ever. So super easy. We're going to dumb it down, make it super simple. What is the easiest option strategy that you could do if you're brand new and getting started? That's what we're going to be talking about today. But if you're still confused, then check out the website, tradersfly.com. There's a lot of stuff here, including some weekly strategies class that we're going to be releasing soon, how to trade single options, adjusting strategies, risk arrays, portfolios, and much more. And if you really want to get in detail, definitely check out the coaching session where I work with people usually on a 2 to 3 month basis, sometimes 6 months if you really want to get into the private mentoring and so on. Let's get started. Let's kick things off. I want to go in and share with you the easiest strategy ever. We're going to go ahead and start with eBay. eBay is a stock that continues to sell off, but now it looks like it might start looking to bounce a little bit. And if you say, hey, I want to go ahead and pick up this stock at a cheaper price because it was down here at $43, $44 a share, and now it's already at 47, you're like, oh man, I missed it. So if you missed this stock, what you can do is go ahead and sell or write against it. So you can sell puts in order to pick up shares at a lower price. So if you're kind of brand new to trading options, this is a great strategy. But note, you do have to have the capability and funding to be able to buy 100 shares. So in this example, if I went ahead and I've got myself a calculator and I have a stock that I want to write some options on. Let's say I want to write some options on around $44 a share. That means $44 a share times one option contract, which controls 100 shares. I need to be able to have $4,400 in my account. Okay, so sometimes you're like right there and very close. I've seen people talk about it. Well, if you don't have $4,400, but you have $4,300, you could try and write for the $42 strike even, times 100 shares, and then it'll only require $4,200 worth of capital. So that's a nice way. But remember, when you do this strategy, what's going to happen is you will get that stock at that price. So that is what's going to happen. So let me show you how this works out. So here's eBay. It's trading at around 47, 45 right now. I want to pick it up at 44 because it's been there. I missed the move. Crap, the sale is over. So I want to go ahead and buy it around 44, even 43 if possible. So what I could do is go to the eBay options area, go to 8-day, 15-day, 22 days. How many days do you really want to hold on to this and deal with it? Remember, the longer the days until that time frame, the more money you'll get. So if I want to go to the 44, okay, I can get $52, okay, or $55. So it's probably somewhere in between that range, okay, bid versus ask. So it'll probably be like around $53, $54, okay, but that's 22 days. If I only hold it till 8 days at the 44, I might only get like 14 cents, or in other words, $14. So what you're doing here is you're kind of insuring the stock that if the stock falls, you're willing to take that stock at a lower price. So that people do this, they insure their stock in case it goes down to like 40 or 35. So what you're doing is you're saying, hey, I'll take that stock off your hands at 44 or 45, whatever price you want. So let's go to 30 days. It's a nice sweet spot for a way to calculate a monthly income. So if you go to 30 days out and you say, hey, I want to pick up that stock for 68, call it 70 cents. So that means about 70 bucks. I can right click, sell a single, and we're doing it on the put side. So here is the puts, here is the calls. So you can see the kind of the difference between these two. So the puts are on this side. This is the Thinkorswim platform. And we're going to go in here. We're going to choose the 44. This is about a delta of 22 in case you were curious. I'll right click, hit sell, go to single. You could do it this way. You could also go in and click the bid. Okay, so if you click the bid right there, it'll come out with a sell action as well. Okay, so now that I've got this, what it's going to do is give you a little diagram right here. And this is a risk profile picture. Now what this tells me is I've got two lines here. I've got a white line, which is today, and a green line, which is at expiration, which is my 29 days or so. So in here, what it tells me is that if I go in and just this stock stands still, I collect that $67, which you can see here at the lower left. Okay, stock price is on the bottom. Current price is $47.47, and profit and loss is on the left. So there's my zero line. So as long as I keep going up, if the stock keeps going up, I can still make money. Okay, because then this insurance becomes worthless and it expires. So I'm insuring this and someone's paying me $67 to make sure they are able to get rid of this stock at $44 in case it drops to like 43, 42, 41, 40, 39. So what we can do is insure the stock and I collect $67. But if it never gets there, well, I pocket the money. It's kind of like, you pay for car insurance, but you never get to use it until the day you do need to use it. So this is what's happening right here. It's no different. So if it stands still, you make money. If it goes up, you make money. If it pulls back a little bit and then expires, as long as it's above that 44, you still make money. If it drops below 44, you get assigned. Now, you could always get out of this earlier if you like, but the white line is the today line. It's going to dictate the value of that insurance contract. And if you've moved up, you'll be profitable and you could take it off early. If it moved down against you and now it's close to hitting that 44, you might actually have to take a loss on it if you decide to get out of it early. So let's say you're in it like 4 or 5 days or 7 days and it starts pulling back. You might have to take a loss at around $30. Let's say this price was $45. Okay, so $45 a share. And you lose $56, okay? But if this happened a little bit later, okay, and we continue to move, which you'll see is the theta decay right here. That's the amount of value it's expiring. So if it happens, another week later, you might only lose $20. However, if you were up here at $47 or $49, you'd be up $56. So this is a great way to pick up stock at a cheaper rate. It's a good way to get paid to wait for that stock to come to you. If you want to buy stock at a cheaper value, you could sell puts on it. These are known as cash secured puts because you have to have the cash in your account. They are known as naked puts that you're selling. But it's a good, simple strategy. It's an easy strategy for people just getting started in the options world. It's not always the safest, okay? But it is kind of the simplest way to go. So sometimes what some people do is they go ahead and turn these into verticals, which I'll give you a quick taste right here. And we buy one and we sell one. And then what we end up doing is creating a vertical construct because if the stock does continue to sell off, at least now we're protected. And this kind of limits our downside risk that way. So anyway, I just wanted to share with you the single concept, the easiest strategy in the world for those people that are just getting started with option trading. But again, there's many other things that you could do with options. There's a mess of things, and really just about knowing and understanding what you can do, broadening your education, broadening your horizons, and can you continue to expand your knowledge. This one is a little more capital intensive, but it's pretty simple. So if you're just getting started, it's a good one to kind of research and take a look at because you'll be able to pick up the stock at a lower price. But if it continues to head higher, you get to keep that premium and money, and you could get out of it early at any time if you like. If it goes beyond your level on the put and goes lower, you will get that stock assigned at 44 in this case. But if it goes down to 40, you'll still have to buy that stock at 44, which means you get the loss difference between those two prices or values. All right. So I hope that helps, gives you some insight. Thank you so much for joining me. Enjoy the rest of the day and week ahead, and I will see you in the next video.